to greet everybody tonight. Thank you for participating in the back office presentation, particularly the financial management piece, because this is very important. Even though I have another startup company, I had a previous business that I had for 14 years, and I actually lost that business. That's another day and another story. But I lost it 10 years ago, and I went back into corporate America. And corporate America treated me very well during the years that I built the Cardinals ballpark and then was at BJC. But I realized that I was still an entrepreneur and I was a fish out of water, regardless of how well I was being treated in corporate America. So I took it upon myself to make another decision, and that decision was to go back and to be an entrepreneur again. So it took me about a year to plan it and to decide how I was going to resign from BJC, where I knew everybody was going to say, "You're crazy. You know, what are you thinking about? This is a place where people go and they don't leave." Particularly when you go in certain senior level positions, which I was fortunate enough to have. But I wanted to be back in the water again. So one of the things when I would stand before these groups, I'm talking to them from a corporate perspective. And even though I had a lot of years of being an entrepreneur, I wanted to be back in that arena. And so I'm really comfortable. I'm back in the water now. And so when I talk to you, I not only talk to you from past experience, but I can talk to you from present experience. I think you guys are going to enjoy Darlene Davis. She's a very knowledgeable financial management person, and she'll be able to help you run your businesses more effectively. I found over the years that you never stop learning. Doesn't matter how long you are in business. You wake up tomorrow and it's as if sometimes it's your first day all over again, because you're learning something that you didn't know before. Make sure you ask a lot of questions. I got a few of my own because I'm back in business now, but I know a lot more than I used to, and I'm very grateful for that and for this space that they've allowed me to say hello. I'll be back, I'm sure, on some of the other workshops. Hopefully they'll never fire me from this position, but I enjoy it. I enjoy meeting new people and helping people as much as I can.
I'm the principal owner of Davis Associates CPAs, and we are a full-service CPA firm. We provide accounting, audit, tax, management, consulting, payroll services, some litigation support services, as well as educational training and seminars. And we primarily serve small to middle market businesses, nonprofits, churches, and clergy, and of course, individual clients. And Marie Yancey asked if I would come and speak with you today. And I said, well, Marie, what am I supposed to talk about? And she kind of gave me free rein to figure out what I wanted to talk about. And it just so happened that what I wanted to talk about was the same thing that Susan wanted to talk about. So it was good. So I'm going to, in the time that we have, discuss business entity setup options, because it does matter how you initially set up your business. It matters when it's time to pay your taxes. It matters when you decide you want to take money out of your business. So want to make sure that we understand what the different options are and how you will pay your taxes based on how you set your business up. And then we'll go into cash versus accrual. Which one should you really use? Should you use both? Should you use one over the other? Or what's the impact? And then the components of the financial statements. Real briefly, we'll talk about that. And if I have time after that, this is the second talk that I had to do today. Earlier, I was with the SBA. They had an event at Harris Stowe, and sat on the panel where we discussed the Affordable Care Act. And there's so much information that small business owners need to know about that Affordable Care Act, because I guarantee you it's probably going to impact everyone in the room. So if we have time, I may throw in some of that, Marie, just since it's so fresh in my mind. My first question, if your business was established as an LLC, how are you taxed? Now, unfortunately, the slide didn't work the way it was supposed to work, because the answer wasn't supposed to be there, but it's there. But it depends. You want to guess? It depends. It depends how you are going to be taxed. The LLC is actually a legal entity. It is a legal setup. The IRS really doesn't care that you are an LLC. We get new clients who come into our office and I say, well, how have you been filing your taxes? Well, I haven't filed any. It's a brand new company. So they'll say, I file as an LLC. Well, an LLC, you can file your taxes. You could be a single member LLC and file a Schedule C on your personal 1040 return. You can be an LLC and file as a partnership return. The single member LLC, of course, there's only one person who owns it. The partnership, you have to have more than one person owning it. The S corporation is an election that you can take with the IRS. So you can be an LLC and pay your taxes as an S corp. One of the biggest questions that I get from new clients when they come in and they've already established their LLC, and I recommend that they make an S corp election, they get really, really nervous because they think they'll no longer be an LLC. You can be an LLC because that's a legal status that the state gives you. The IRS has nothing to do with you being able to be an LLC. Then you make an election on how you're going to pay your taxes. So you can be an LLC and an S corp all at the same time.
How do you make that election?
You make that election. There is a form that we fill out and send to the IRS, and we're going to talk about that a little bit more. It has to be approved from the IRS prior to you filing your S corp return, but we'll go into that. And also, you can be a corporation. And yeah, you can be an LLC and pay your taxes as a corporation, or you can just set yourself up as a corporation. The CPA who had you as an S corp then told you to change to a C corp, and now is telling you to change back to an S corp. Please tell me there was two different CPAs and not the same CPA.
It was.
The same CPA?
No, it was
Okay. So Jeffrey Randall is here, who's also a CPA. So Jeffrey, please chime in if there's any information that we need to make sure the audience is aware of. Single member LLC. This is where you are the sole owner of the company. So it's not a husband and wife who owns the company jointly. It's a single member, one sole owner. When you are a single member LLC, when it's time to prepare your taxes, you must prepare those taxes on a Schedule C, which is a schedule that's on your regular 1040 tax return. We're all familiar with your 1040. So this is just an additional schedule where all of your income and expense items would be disclosed on your personal tax return. The biggest surprise that new clients seem to have when they've started a business, they didn't make any election, they've gone all year, and they're happy because they made some money. Now, there's no money in the bank, but they made some money. There's no money in the bank because they took that infamous owner's draw. So the money is gone, but we have net income. And now we prepare their tax return, and we have a tax that they were not aware that they were going to have to pay, called self-employment tax. Been surprised by that, 15.3% off the top. And that's only self-employment tax. That's not your regular income tax. So if you're already in a 15 or 20% or 25% tax bracket, add another 15.3% on top of that. So don't get surprised by that. Owner's draw, they are allowed in, if you are a single member LLC, you're the owner, you can take all the money you want. You don't get a tax deduction for it, but you can take all the money you want. That's why come tax time, when it's time to pay the taxes, there's no more money left. So you want to be careful of that. Now I have an example here. Okay. Look at the financial statement part first. Okay. We're going to assume that there's a business in here. Your sales revenue for the year was $250,000. You guys with me there? Your cost of sales, so the money that you had to spend to earn your sales revenue, was $125. So we have $125 gross profit left over. Okay? Your operating expenses, your insurance, your rent, your telephone, your utilities, etc. All of that added up to about $75,000. So those are your operating expenses. Everybody with me? Basic income statement here. So bottom line net income is $50,000. Okay, so your CPA has your tax return, and we're Schedule C on a 1040 because we're a single member LLC. We didn't make any elections. $50,000 is what we have to pay our taxes on. Now we're going to assume your effective tax rate is 20%. Okay, so 20% is the income tax that you have to pay on that $50,000. Throughout the year, in this example, the owner, he made $50,000. So there's some nice money in the bank. So throughout the year, he's taking money out, and it all added up to $40,000. All these checks that were written to the owner, that's called owner's draw. Well, guess what? We don't get to include that $40,000 in those operating expenses. That's owner's draw. So you don't get a tax deduction for that. You guys with me? And this is what causes a lot of small business owners problems. So we know we have a 20% income tax effective rate. But guess what? We had the 15.3%, and that is going to be calculated on the $50,000, the net income that's left over. So the tax impact when you are a single member LLC, you didn't make any elections, maybe because you didn't know that there were any elections that were available to you. So you just started the business, you're expert at what you do, you just don't know anything about the taxes, but good, you're here. Full disclosure on your personal tax return. So when you do your return, there's the Schedule C. So if you go to the bank or you want to get financed for something and they want your personal return, your personal and business stuff all is there. Okay, so if you have to give that information to someone, they're going to see all of your information. You may not necessarily want people to see all of your information. You pay the income tax, as I said, on the $50,000 on your bottom line net income. Self-employment tax, you're going to pay 15.3% of that on the $50,000. Now the IRS gives you some adjustment off of that. I think it's maybe 98% of it is what you're going to have to actually calculate the tax bill on. Now whatever that 15.3% comes up to, the IRS, they want to have a little bit of mercy on you, okay, for what that's worth. Half of that amount, you will be allowed to take an adjustment off of the front of your tax return. So whatever that calculates to be, you will get to take that as an adjustment to lower your adjusted gross income, okay? Now, and that's a good thing because it lowers your tax bill a little bit. But as small business owners, sometimes you have to give your financials to get financing for something, and you want the income to show as much as possible. We want to show that we make enough money, but then we don't want to pay the taxes on. So that adjustment lowers your adjusted gross income. So now that number is a little lower than what you may want it to be, but it's still good from a tax standpoint. In this situation, the tax bill is going to be, the 20% is actually going to be $9,235. And the reason that's not an exact number is we've made the adjustment for half of the self-employment tax. So the numbers work out. That's your income tax bill, but don't forget, this is where everybody gets surprised. We got to add an extra $7,600 for that self-employment tax. So now you made $50,000. Throughout the year, you have $40,000 of owner's draw, and now you have almost a $17,000 tax bill. And we're lucky if we still have that $10,000 left in the bank. There goes the problem. Okay? Is that clear enough? Yes, sir.
$7,650, that's the individual?
That's the 15.3% on the net income of the business with the other adjustments.
That's not half of the 15.
That's not half. That is the 15.3%. The 92.35, we've already adjusted for that half.
For the half, okay.
Yeah.
That would have been higher had you not.
Yeah, but the IRS allows you to get that half. Okay, and one thing about the self-employment tax, I didn't say this, but maybe you know it, but the self-employment tax, that is how you pay into Social Security. Okay, so Theoretically, you'll get that money back eventually, maybe. So, but at the time, come April 15th, that's money you have to come up with. So that's where we see a lot of small business owners, there's the disconnect, and they're like, well, how could I possibly owe this much money? You didn't do this tax return right. It's right, you just don't have the right setup, okay? My second question, how soon can you file an S-Corp tax return? And the answer's already up there. It's after the IRS has approved you. Do not file it prior to that. A couple years ago, the IRS eased those rules a little bit, and if you are in the first year of establishing the business and you haven't actually made the election to be taxed as an S-Corp, you can file that S-Corp return in that first year, and on the return, you can petition them to approve you as an S-Corp. And there's a tax form, I believe it's 2553, is the form that you have to complete and send in to the IRS to get that approval.
So
Okay.
for first year business.
If you're first year in business and you want the S-Corp return and you didn't know it, you've already set up the business, so when you set it up, you didn't make the election at that time. When you file that first tax return, you can go ahead and do it on the S-Corp, the 1120S, and there is a 2553 form that must be completed. And there's certain language that you have to put on there, because you have to give the IRS a reason why you didn't do it the way that they really want you to do it. And so there's certain language you put on there. and I've never seen an S-Corp not get approved. Jeffrey, have you ever seen one not? They're gonna approve it. Yeah. What I have experienced, so this year when we filed the return the first time and they hadn't been approved, the IRS, and it surprised me, they actually called and wanted some additional information about that particular client that we had done that on. So we had to put the legal language that is filed pursuant to a revenue proclamation code, and then it went straight through. Not a hard process. If you can read and you're running a business, you can do it yourself, or you can hire a CPA, pay us a fee, and we'll do it for you. Either way. On an S-Corp, there is no self-employment tax. So that extra money that just shocked us on the C-Corp, you don't have that come tax time, okay?
That was on the LLC.
Okay, let me go back. One of the first things I said earlier, the LLC is a legal status that the state gives you. So both of these examples are LLCs. Okay? You sure you're with me? Because
I think so.
okay. You can be an LLC in any of these entities. That's consistent across the top. It's how you pay your taxes. So in that first instance, we had a business where there was only one owner, so they were a sole proprietor, basically, a single member LLC. In this situation, we still have one owner. They just knew the benefits of filing as an S-Corp, so they made the election, and they're going to avoid, at tax time, that 15.3 self-employment tax. Now, one catch that the IRS, there's a catch to everything, so it's just important that you guys know the rules and plan accordingly. The IRS requires the primary owner of the S-Corp to take a reasonable wage, so a reasonable salary. The IRS does not define reasonable. They leave it there, so if they decide to audit you, they may say, well, this isn't reasonable. Well, now we have to defend, how do we determine what was reasonable? Sometimes reasonable might be a $1,000 salary, or reasonable might be a $50,000 salary. It depends on at what stage you're in your business, the revenues, the expenses, and the cash flow. Because if you ran your business at a total loss and there was no cash left, then $1,000 may very well be reasonable. Or if you had in our example, was $50,000 net income left over, then 30,000, 20,000, 40,000 may be reasonable. So you have to pay yourself a reasonable wage. Just understand that the IRS does not necessarily define reasonable. It is based on the cash flow and other things going on in the business. So I don't recommend that you play games with that, because if the IRS audits your return and you cannot justify your reasonableness in your salary, they're going to turn all of it back into salary, charge you all of the taxes that you didn't pay, plus penalties and interest. So just do the right thing. I've learned in business it's just best just to do the right thing for longevity. The salary can fluctuate, and it does not mean that you have to be on every payroll, because some payrolls you may not have enough cash. Once you pay the employees and pay all the bills, you may not get a payroll check. So the IRS, they're not checking to see that you're on every payroll. Just by the time we get to the end of the year, you need to have paid yourself a reasonable salary. You may give yourself one check a quarter. You may wait till the end of the year, see how much money you got left over, and pay yourself a check then so that you meet that requirement. Or for mature businesses where your revenues are set, you have your expenses under control, just put yourself on payroll, and every time you pay your employees, pay yourself. I remember when I first put myself on payroll, I was like, wow, this is good. I'm getting paid just like everybody else. So, yes, ma'am.
I should not do an owner's draw. It should run through payroll. It should be processed as payroll.
Have you made an S-Corp election?
Yes.
Let me explain the owner's draw. Okay. You still may be entitled to an owner's draw. What you have to watch out for on an owner's draw when you're an S-Corp, the draw that the owner takes out cannot exceed the amount of basis that the owner has. Okay, so if you had $10,000 left over in net income the previous year, you now have $10,000 worth of basis in that business. So you still have that you can take out. If you have a negative basis or you go beyond the amount of basis you have, when you still take an owner's draw, you have in effect paid yourself a dividend, and that dividend has to show up as taxable income on your personal return.
Okay.
So in a single member LLC that's taxed on your Schedule C, you can take an owner's draw all day long. On an S-Corp, there are draws that can be done. Just be careful. You have to track the amount. You cannot take a draw. Well, you can take it beyond your basis, but know that you've created a taxable event. And that's where people get in trouble thinking, oh, well, I'm just not going to pay myself. I'm going to be S-Corp and then take a draw. You can't do that. Okay. Okay, let's move.
I understand the base.
Okay, you start a business with zero. Okay. You go down to the Secretary of State and you pay $100 and you get it set up. Your basis right now is $100 in that business. So what you inject in is what you start with as your basis. Okay. Then the first year, you're running the business and you had to put in $10,000 to make payroll. Okay, and that's $10,000. You're just of your personal money you're injecting in the business. So now your basis is $10,100. Okay, the $100 you originally put in plus the extra $10,000 of money you had to put in out of your personal that you're not getting back. You didn't loan it. You just had to inject it in. Okay. It's not basis if you loan it to the company and then you're going to pay it back. It's just money you put in. And now let's get rid of that 100 because I'm going to forget about it. We just got 10,000. Okay, forget that 100. You went through the whole year and you made $40,000. Net income, $40,000. Revenue minus all of your expenses, net income, $40,000. So now your basis now increases by that net profit. So we had 10, we now have 40 added to it. We have a basis in that business of 50,000. Are you familiar with the term retained earnings? It's similar to retained earnings, okay? But now, if you take money out, or if you lose money, the next year you lost some money. So you lost $20,000. So we had a $50,000 basis. We lost money the next year. We lost $30,000. So now our basis is down to $20,000. Okay. So what increases your basis is when the owner injects money and when the business makes money, makes net income, revenue minus the expenses. And what reduces the basis is when the owner takes an owner's draw or when we lose money. Okay, and that's important for you to know for partnerships as well, because when you have losses in your partnership, did you guys know you can only deduct those losses up to your basis? A lot of companies get into trouble with that, where they just keep deducting all their losses year after year after year. They haven't even tracked, they don't even know what their basis is. Well, after so many years, you know you have exceeded your basis.
I have a quick question. I know most businesses have been in business for a while, but for a brand new business, for example, like say you started a business, you established the LLC at the end of the year, like November,
Okay.
and you had no income.
Uh-huh.
Are taxes due at the end of, like, if
You had no income and no expenses?
other than the startup expenses?
So do you need to file a tax return?
Yes.
One thing that the IRS allows, and I believe the amount is $5,000. A couple years ago it was $10,000, and then they switched, I believe it's $5,000, where you are allowed to write off up to $5,000 in startup expenses. So even though your business isn't really in service yet, they still allow you to write that off. Okay, and I think a couple years ago, Jeffrey, I don't know if you remember it, one of the stimulus packages upped it to $10,000, so that was a real good year. So it may be to your benefit to file, especially if it's a flow through that's going to flow through to your personal return. If you're a Schedule C, you definitely want to file it, but be very, very careful. Make sure it's a legitimate business, that you have an intent. You just started it at the end of the year, because that's a hot area where the IRS is auditing. There are so many people setting up fictitious, bogus businesses, and they have no intent of it being a real business, and then they try to flow that through. The IRS is auditing that hot and heavy. The other option you have is to keep those expenses as startup expenses, and then once the business is actually in service, it's up and running, then you get to basically amortize those startup
But you don't
expenses.
penalize for not filing for that end of the year, you know, for not filing taxes for the year you established it if you had no official.
You won't be penalized. The IRS might send you a letter and ask, well, where's your tax return? And just let them know the business didn't get up and going until the next year. Okay, and they can't penalize you if they're, penalties are calculated based on the tax that's due. In that situation, no income, you can't penalize me. Okay, let me go through an example of the S Corp. Okay, same facts, revenues $250, cost of sales $125, our bottom line net income $50,000, same as the other company. Effective tax rate on your personal 20%. And the owner benefit, okay? This owner benefit, the owner took $40,000. Remember, I said that the IRS requires the owner to pay themselves a reasonable wage. So in this scenario, that reasonable wage was $40,000, okay? The tax impact, when you file, and that should say 1120S, when you file your S Corp, that's a separate return. It is not part of your 1040. So when you go to get your taxes prepared, be prepared to pay 2 tax preparation fees, okay? You have to file an 1120S. The 1120S will generate what's called a Schedule K1. And I like to equate a Schedule K1 to be similar to a W-2. So when you work for an employer, they give you a W-2 showing how much money they paid you. Well, when you own an S Corp, then they give you a K1 showing your share of the net income or loss in the financial activity. So then that flows over to your personal tax return. But that's just one line item. It's not all the detail, okay? In this example, the owner's payroll is deductible. So the owner still got the same benefit, $40,000. Remember on the first one, they took $40,000 out, but they didn't get a benefit other than, ooh, I got $40,000 I can pay my bills with, but they didn't get a tax write-off. In this scenario, you get to write that $40,000 off as payroll, because you paid yourself through payroll. Okay, so you're treating yourself just as one of the other employees. You're filing quarterly 941 payroll taxes. When those payroll taxes are due, you're submitting that information to the IRS. Then at the end of the year, your business that you own will issue you a W-2 that shows you got $40,000. Okay? So the part that the business paid is also a tax deduction. So in this case, the $40,000, the cash, you see here where before we had $10,000 left in cash, now the business only has $6,000 left in cash in this example, because $40,000 of it went to you as the employee, okay? And I just estimated 10% once you throw all those, add all those taxes up. The other 10% was for all of the other taxes that you paid for your employees already, okay? One of the advantages, though, you already have taxes paid in because you were paying it in throughout the year. Okay? It's much easier to come up with the small portion of money throughout the year and pay it than it is a large amount of money at one time at the end of the year. Okay, so the owner's payroll is deductible. The owner will receive a W-2. The income tax on this would be the $6,000, okay, on that net income amount, okay? Well, let me restate that. The income tax that you're going to pay is based off of $6,000. You guys see how I got that? We started with $50,000 of net income. The owner got payroll of this 40, okay? Plus we had about 10% of that for the taxes, okay? So that's $44,000 that was paid out. And so now our bottom line net profit is now $6,000, but you still got the money, okay? But now you get to write it off on the taxes. And so the tax bill on that net income left in the business is $1,200. You're gonna get a W-2, and on that W-2, if you've gotten your withholdings right, or close to right, then you've been paying in on that throughout the year as you received your W-2, the withholdings. Now, if you put exempt and don't have any withholdings on that money, you're gonna have a bad situation. But your company should pay you as a regular employee, do the federal withholdings, and that should even out if you've done your withholdings properly, because you'll have that money withheld. And then on the second page of the tax return, the federal tax is withheld, you get credit for having that paid in.
But the bottom line, which one do you pay less taxes on? When you add your income tax from here plus your personal income tax from here versus taking the owner draw from the other way.
You're gonna be in a better tax situation as an S Corp because that tax bill at the end of the year is gonna be significantly lower. On the owner side, that tax bill, you're only gonna have one tax bill. The business isn't gonna have a separate bill and the owner a separate bill. You're gonna have one tax bill. That S Corp net income or loss flows over to your personal tax return via that K-1. So we only have one tax bill. Okay, does that make sense? Yes, ma'am.
Is it advisable to pay yourself and then at the end of the year you realize you make a lot of money and you want to take some money out as an S Corp?
So at the end of the year when you realize you made a lot of money, what's your question there? What are we going to do with that lot of money? As an owner's drawer? It depends on what your basis is. Okay, because you got to be careful with that, because if you take money out beyond your basis, you now have a dividend.
Can't you call it a bonus, like you would give an employee?
Yep, you can call it a bonus, and that goes on your W-2. Yeah. And I believe in big bonuses. Get rid of that net, unless you have a reason to keep all of that net income on the bottom line, get rid of it. Pay yourself a bonus, because then if it's the cash you're concerned about, you pay yourself a bonus, put that money in the bank, and then if something happens, then you still have access to your cash that you've already paid taxes on that you can use if you need to. But don't let that much net income just sit in the business unless there's a reason. When you know you're going to go to the bank and the bank needs to look at them, they need to be pretty, we need to keep some net income, or we're trying to buy a building. If there's a reason we need to look profitable, then yeah, keep it in the business. But if it's not, you work hard, pay yourself a bonus.
On the $1,200 tax bill, are you taking into account the $4,000 that we already paid off when you said 10% of the $40,000? Because when you said it got rolled in together, and so right now, today, I owe $1,200, but I already paid $4,000 in on the $40,000 as we went on my W-2.
The company, put that in throughout the year as you went. When you file
Now
your...
all I owe is $1,200.
Right, the tax that's due on the business income is that $1,200, so that's what you owe. Be careful when we're so used to doing the owner's draw. There are some very strict rules on the owner's draw. So if you exceed your basis and you take an owner's draw, you've in essence just paid yourself a dividend that's taxable. And if the IRS were to pick your return for audit, they want to know, well, why wasn't this income? So now you have to prove out, and it can't be, oh, well, I didn't know. Well, guess what? Now here's returning it into payroll plus penalties and interest and all that stuff. Okay, what are the 3 ways to take money out of a C corporation? You want to guess? Salary, so you pay yourself as an employee, you get in the W-2. And the C corporation gets to deduct that as a normal operating expense. A dividend. So if you have a C corporation, you can pay yourself a dividend. So we got to the end of the year and we made a lot of money, and we're the owners. We want some of that money because we want to go on a vacation or we want to do whatever. No reason necessarily to keep it in the business. We're not going to the bank for financing, so they don't need to look real nice and pretty and profitable. So we're going to spend some of the money because we work hard. We deserve some of that money. Pay yourself a dividend. You can get that money. The thing you have to remember about a dividend in a corporation, if you and I are partners and I've been working hard, but you haven't been working hard, when we pay that dividend, whatever your share of the stock, you get the same dividend that I get based on our ownership of the stock. So it can't be, well, you didn't work hard, but I worked hard, so I'm going to get the whole $50,000 dividend. The dividend is based on your ownership in the stock. For example, like Ameren. Ameren pays a quarterly dividend like clockwork. That's pretty good stock to have. And so if you're little Joe Blow and you own 1 share of Ameren, you're going to get the same dividend that, I can't think of the gentleman's name now, who owns all the Ameren stock. The difference is he owns more shares than you. That's why his check is a little bit better. But you guys got the same pro rata share of that dividend. That makes sense? Okay. So if you know you have a corporation and the other stockholders don't work as hard as you do, you may want to think long and hard about being a C Corp and paying dividends. The other way you can get money out is sell your stock. So I'm going to cash this stock in, so now I own a lesser amount of the business than I did before because I had to sell to you part of my interest because I needed money. So those are the only ways that you really can take money out of a C corporation. And let me say this loud and clear. There is no such thing as an owner's draw in a C corporation. I have seen companies go down on people really, really hard that put them out of business because they were doing this. And their only response was, I didn't know. Very costly, very expensive lesson, because all of that money is now a dividend that, of course, they never put on their tax return, and it created a huge tax liability. There is no such thing as an owner's draw in a C corporation, okay? The difference between an owner's draw and a dividend, it depends on the entity, okay? The owner's draw, the basic definition, the owner's draw is when the owner is drawing out of the business earnings that were already previously taxed. Does that make sense? Okay. I don't want to get too techie. Okay. Did that make sense to you or no? Okay. The dividend is still earnings of the company that is given to the owners of the company. A dividend is a taxable event. 100% of the time, a dividend is a taxable event. So you should get a 1099 DIV, dividend statement, or for smaller businesses, you don't do the 1099 DIVs, but you're still responsible for reporting that as a dividend. The C corporation, the problem that Susan has on the C corporation, she feels like she's being double taxed. Well, guess what? You are. And that was one of the, I believe one of the overriding reasons why the LLC was established was to help to ease some of that. And then you have the other tax elections you can make. But also there are administrative hassles or extra effort when you are a C corporation. You have to remember every year to file your registration papers, otherwise they're going to administratively dissolve you, and you're going to look up and you need your business license, or you have this big contract, you go on the website and you're not even still in business and you didn't even know it, okay? You file for an LLC through the state. You are an LLC, if when you filed it, if you put perpetual on there, you're an LLC forever. Okay, so you can set it up and then forget about it. Okay, let's look at this one. Next slide. Same scenario. Okay, in this case, the owner's benefit is a dividend. Okay, and same net income. The tax impact, a corporation pays income tax at the corporate rate, which generally 35, I think up to maybe 39%, okay? So usually the corporate rate is gonna be a lot higher than your personal tax rate, okay? So keep that in mind. And there are some organizations where it does make sense for you to be a corporation, depending on who owns it. One thing that I think is very good about a corporation, the asset ownership and the tax structure, it's all in its own entity. It does not flow over to the personal owner, the primary owner. If you're a single member LLC, that's going to hit your personal return. If you are an S Corp, that's going to hit your personal return. If you are a C corporation, that is just going to stay in that entity. Okay? So that's one of the benefits. The $40,000 that the owner received, we have two choices. That can be received either as a dividend, and what we learned about dividends, you pay taxes at whatever the going dividend rate is, or it's a wage. You put yourself on payroll, pay yourself a bonus, pay the taxes when the money is taken out. At the end of the year, you get a W-2, okay? It keeps it nice and clean. An owner's draw does not exist. Please, please, please stay away from this, because if you get in trouble on this and then the IRS is auditing you, and if you come to my office for help, if you go to Jeffrey Randall's office for help, there's not a whole bunch we can do. Not a whole bunch we can do. So, other than tell you owe these taxes. The tax bill in this situation, for the corporation, is about 17.5 for the corporation based on this level of income. And on your personal side, it's still about 8,000. Trying to see how, I did that on the dividend. If you just totally have to keep everything separate, there may be marital situations or something, and you don't want all of that to flow over to your personal tax returns. But from a tax standpoint, I can't think of any real good reason.
So
Why?
Companies, corporations at all?
Well, and that's for small businesses. Now, when you get to the larger, like the Monsantos and Anheuser-Busch's of the world, you're public at that point. You dealing with a zillion shareholders. It makes sense when you get to that point. You're not dealing with one or two owners where we need to take this money out or something. So it makes sense for much larger organizations. It doesn't make sense for small businesses. When you decide to do your IPO, then it makes sense. Remember, the IRS requires that you pay yourself a reasonable wage. It doesn't mean you have to be payroll every other Friday. That's not what that means. So the freelance can still put themselves on payroll. And I think it's a good business management tool too. Treat yourself as an employee. You work hard, try to put yourself on some reasonable schedule, but they can base their payroll on the cash flow that comes in. So if nothing happened this month, you don't get any payroll. Something happened next month, you get
So it's
payroll.
You can still do payroll?
You can still, yeah. And you can still do payroll if you're the only one on the payroll. So, okay, these are the things I want you to consider. How will you take money from your business? That will have an impact on which one you choose, okay? If you just can't live without doing an owner's draw, don't set yourself up as a C corporation, okay? If you're good with doing the owner's draw and you don't want payroll and file quarterly taxes, then you're going to keep doing your owner's draw. You don't mind having that self-employment tax surprise at the end of the year. Be a sole proprietor, Schedule C. Are other partners involved, like your situation, okay? Because when you do a dividend, it's your pro rata share. When you take those draws, like in a partnership, it's whatever your percent of ownership. So keep that in mind. So if I work harder than you, I don't think you should get the same draw that I got. So just keep those types of things in mind. If it's important for you to separate the business from the personal, there are some times when you have to give someone your tax return, you don't want them to see everything. Or they need to see the business stuff, but you don't want them in your personal, because you didn't decide, and I'm not giving one more personal guarantee. Here's my business stuff. Approve it on my business, or just don't give it to me. So if that's important for you to keep that. And then the ease of administrative filings. You have to do more stuff if it's a corporation than you do if you just file the LLC. Okay, next slide, please. I don't know how well you guys can see this at all. And I should have printed it out for you. And I apologize, because I know you can't see it in your handout. Marie, can I email this to you, and you have a way to send it out to everyone? All right. This is a real good compare and contrast to the differences in each of the entities. The sole proprietor, as far as your legal liability, if you hadn't even set up an LLC, your liability is unlimited. You go out and, God forbid, run over somebody's toe, they're coming after you because it was you who did it. You didn't have the protection of being in a partnership and you have limited liability in a partnership, or a corporation. If Monsanto is a corporation. If you worked at Monsanto and you were on the job and you ran over someone's toe, that person whose toe you ran over can't come after you because you were working as an employee. They have to go after Monsanto. So that's the corporation piece. The S Corp is limited as well. And as we have here, the LLC, a lot of that just depends on how you pay your taxes. So keep in mind that that LLC is a legal entity. Next one. Okay. When you charge an expense on the credit card, when do you get the tax deduction? Generally, when you charge it. Okay, so that's why on December 31st, let's say on the 20th, you met with your CPA and we told you, okay, we need some more tax deductions. If you need a new computer, go buy a computer, go buy a car, go buy a copier, go buy some machinery, some equipment so we can get the tax deduction down, because you're going to buy the stuff anyway. Might as well buy it now so we can reduce the tax bill. Well, I don't have any money to buy it. Well, that doesn't really matter. Go get it anyway so we can get the tax deduction. So the depend part, let's do the next slide, goes into the cash versus accrual piece, okay? So generally, when you put it on that credit card, you're going to get the tax deduction then. It's as if you paid it, even though you're not even going to get the credit card bill until January or whenever. Accrual buys you time, okay? So accrual accounting is where you record pretty much everything that's going on in your business as it happens, irregardless of if you've received the cash in or if you've paid the cash out, okay? So last month you did a lot of work putting somebody's roof on, okay? So, and you're gonna build them. That construction is a little different. That's not a good example. I sold this microphone. I'm a distributor. I sold this microphone today, so I'm going to invoice you today for selling you this. So today, that is revenue. I have sales revenue. But all I did was gave you the microphone. You accepted it. So you have a microphone you get to use. I sold it. I have sales revenue, and I have an accounts receivable. I don't have any money in the bank, but I have a lot of sales. And that's one thing you guys have to be very careful when you are looking at your financials. Analyze the amount of days it's taken to turn over your accounts receivable, because that is money. Okay, so on an accrual basis, you will have the accounts receivable that you have to set up and the sale at the same time. On cash versus accrual, when the cash is gone, the game is over, okay? Accrual does give you the best picture of your business's actual performance. It's best to manage your business on the accrual basis, but on the tax standpoint, you want to file your tax return on a cash basis. Now, does that sound like just too much work? It really isn't. Let's go to the next slide. The big difference on your financial statements, you will have accounts payable and accounts receivable that you have to make sure is set up. So when you purchase this microphone from me, you didn't give me a check because I trust you. I'm going to bill you. I sent you the invoice. You now have a payable on your books and an expense. Although you still have your money, you haven't paid me for it yet, okay? So on your financial statements, he's going to show that he had that cost. So he may need microphones because he's in the business of doing something music related or audio related or something. And so he's going to get revenue from his customer in that same month. And now the fact that you had to get this microphone from me is going to match up in that same month, even though you haven't billed your customer yet and you haven't paid me for my microphone. But we know in that month, that's when all of that activity happened. The cash basis is where you record your revenues as the cash comes in and you record your expenses as they go out. Not a good way to measure the financial performance of your business. A lot of small businesses, we end up doing that because we don't want to invest in the accounting system, and QuickBooks only costs $2.99 Office Max, Office Depot every day of the week. And you catch it on sale, you can get it cheaper. We have to invest in that. Invest in a CPA, a good accountant to help maintain that so you can use those as measurements, okay? One thing that the IRS allows, do we have any businesses in here with more than 10 million in revenue? Okay, good, so this is gonna apply.
But Centrex,
This won't apply to if your 10 million is the limit. So 10 million one, you can't do this. The IRS allows small businesses with $10 million or less in revenue to file their taxes on a cash basis. That way, you're matching the cash that came in with the cash that went out. You're determining your net income, your taxable income on that number, okay, as opposed to the accrual, because if I still have a lot of accounts receivable on my books, I haven't received that cash in, so why should I have to pay taxes on it? The IRS recognizes that, and they give relief to small businesses, 10 million or less. Once you get over that, they don't consider you a small business anymore for tax purposes. Okay, so that's matching your tax bill with the cash you have in the bank. One thing you cannot do, you can't go back and forth, back and forth, back and forth. Okay, you can't one year, well, I'm gonna do it on cash basis, next year I'm gonna do it on an accrual basis, because over time it evens out. Okay, so if you have accrual revenue of, let's say 100,000, but we still have 20,000 in accounts receivable. When it's time to do the tax return, our revenues are only going to show up at the 100,000 minus the 20, so at $80,000 is your revenue, as opposed to the 100. Okay. Now on the flip side of that, the items that are still sitting in accounts payable at the end of the year, okay, that's your regular operating stuff. You don't get a tax deduction on those items in that year because you haven't paid it, okay? That does not take into account like the machinery and equipment. You went and bought a copier that you're financing, or a piece of equipment or company car or something like that. We know you haven't paid that, but you're going to get the regular depreciation deduction for that anyway. So the accounts payable piece that I'm referring to are those operating expenses, okay, the office supplies or the paper clips and stuff like that. Okay, does that make sense? I didn't do a whole bunch on the cash versus accrual, but the important thing on the financial statement side, if you want to be able to effectively manage the operations of your business, you want your accounting records maintained on the accrual basis of accounting. It's your best measurement of what's going on, okay? So you'll see the payroll that went out was matched to this amount of sales. You can't just do it on the money in and coming in, money out, because you're going to have that payroll. That's a real-time expense, but the sales that payroll supported, you may not get the cash for that for another 30, 60, God forbid, 90 days, okay? But you need to be able to see that so you can see how much it really costs to generate that level of revenue. Then at the end of the year, and if you have a good CPA or tax preparer, they'll be able to do the accrual to cash adjustments on your tax return. So it doesn't mean that you have to keep two separate sets of books. It just means we need to be able to make sure that you're keeping a good set of accrual-based records, and then your CPA can make the book tax adjustments, the accrual to cash adjustments when it's time to prepare the tax return. Okay? Any questions on that? No questions? Okay. The components of the financial statements. This was another item that was on the list for me to talk about. When your banker asks you for your financial statements, that includes a balance sheet, income statement, statement of cash flows, typically, okay? The balance sheet shows all of the assets and liabilities and I don't want to say the net worth, but the accumulated earnings of the business since inception, okay? And it should show if you have different owners, you've been taking owner's draw, it's going to keep track of that. Your basis can be tracked on that balance sheet because down in the equity portion, we can have a determination of how much basis we still have, okay? On that balance sheet, we already discovered we're going to keep our books on an accrual basis, so our accounts receivables will be set up there, okay? Our accounts payable, those are the bills that we still need to pay, okay? And of course, your reconciled cash, and I know I don't need to tell anyone that our cash accounts should be reconciled on a monthly basis. You cannot just go on the internet, call up the account, ooh, I still have $50,000. Well, no, you had payroll that hasn't hit yet, or the payroll taxes that are going to be EFTPS that's coming out in the next 2 days, so you really don't have all the money that you think you have. So reconcile definitely on a monthly basis, but then keep track of what's going in and out. The income statement, of course, that shows all your revenue sources, and what I recommend if you have more than one line of product or service that you do, it's a good idea if you keep the revenue in different accounts. Like you can have a sub-account, okay? For example, and I'll just use myself an example. At my firm, we do audits. So we have one line of revenue that's called audits. We do taxes. We have another line that's called taxes. We do accounting. So we have another line called accounting. We do payroll. So we have another line called payroll. It's all revenue, but then when I want to spend time managing the business to decide, okay, where is our money coming from? What are we good at? What are we good at generating revenue? So I can see each category, okay? And then you can track which category is growing and which one is declining, as opposed to just one line item, sales. But the commercial, plumbing business, yeah, you would keep those separate too. You could keep them in classes, or on your revenue, you keep them as two separate line items where all of your commercial plumbing goes here and all of your residential plumbing. But what I'm really referring to is drilling down on that revenue source. And in plumbing, all I know plumbing is plumbing. So I don't know if you do plumbing, like drain cleaning plumbing, or the toilet backed up plumbing, or my garage, the garbage thing isn't working plumbing. If those are three different types of plumbing, that's all under residential. Okay, did I say that clear enough? Okay, but you can, if you're using QuickBooks, you can do something as simple as create classes too. So if you wanted to see everything relating to the residential plumbing, so you charge it over there to residential, and then you can run financial reports just on that residential, okay? Statement of cash flows. This is probably one of the most challenging and most underused statements. And I know even for accountants, the statement of cash flow sometimes is difficult. But it's an important tool because it shows you where your money went. And it never fails when we have a client that ends up and we show them, this is your net income. And they're like, how did I make so much money? Where is the money? First thing I do is turn to the cash flow, because then that shows them where the money is. It was really funny, a client here recently, those are their exact words. Well, where did all that money go? How did I make all this? Turn to the cash flow. And they started another business. So the existing business, which is very profitable, they keep taking money out to fund this other business. Well, that's why you don't have any money here, because you're taking it out to fund this other business. They're like, oh, it's right there, the cash flow. It shows you where the money went. If you have debt, this is another one where people sometimes don't understand How can my net income number be so high and I don't have any money in the bank? If you have debt, the amount of that debt that's being factored into your bottom line net profit is only the interest portion of that monthly bill you're paying. Okay, that principal portion of that debt, that's going to your balance sheet, and you're not getting a tax deduction per se at that point. When you do that, you will get depreciation on whatever that debt you purchased with that debt. So you bought a building, you're going to get depreciation on the building. But when you're paying that principal portion of that debt, you don't get a tax deduction for that. You don't get to write that off. You guys understand that? You don't get to write. That's the bank, they gave you money to hold for a minute, you're giving them their money back. Only the interest portion. So your bottom line, you know, I've spent more money than that. Well, yeah, but you don't get a deduction for that principal portion of your debt. You didn't count it as income, and you use that money to purchase something or that you got to take the deduction for. Okay? We get a lot of new clients who come to us. Do we have any CDS clients in here? Anybody involved in CDS? This seems to be like really, really big. Everybody's opening up CDS.
What is CDS?
CDS is consumer directed services. It's where if you have it's a home health care type business, and if you have an elderly person who needs medical attention, then you can hire people and they can hire their relatives to go in and take care of that person, and then they get money from the state. We've gotten a large influx of those clients, and they come in and they say, oh, I need an audit. I'm like, okay, let me have how have you been maintaining your accounting records? That's the first question we ask. Well, I've been doing it myself. Okay, so you're an accountant and a home health care worker. Those two probably didn't mix well. So I tell them, send me your balance sheet and income statement. Balance sheet, well, what's that? So they don't have accounting records. You are not auditable unless you have a balance sheet and an income statement. Okay, so if your banker tells you you need an audit, you have to first have financial statements. Okay, and I'm glad that I have a relationship with Jeffrey Randall, because sometimes we tag team. Okay, Jeffrey, I'm going to do the accounting, then I'm send them over to you to do the audit work, or vice versa. Okay, but you have to have financial statements, your balance sheet and income statement. And an audit is the highest level of work that a CPA can do for you. Sometimes people come to us and they think they need an audit, and what we do, we ask them, well, what do you need the audit for? Because sometimes an audit is not necessarily what they have to have. For some insurance companies, the first word that comes out, I need an audit. A lot of times, they'll be satisfied with the review. You say, why the difference between an audit and a review? An audit is very expensive, okay? As best I know, the cheapest you're gonna get an audit on the cheap end, and Jeffrey can correct me if I'm wrong, is around $5,000 for a small audit. And that's a very small audit. So audits are very expensive. And then a review is the next level. And that's if we can get in and out. Would you agree with that? We need to be able to get in and out. Don't make me do a whole bunch of work. The next level is a review, and that's where the CPA will take your financial statements. Again, you have to have financial records. We can't put the financial records together and then review them or audit, because then we would be auditing our own work. But the review it gives a little less assurance than an audit does, but it at least gives the user of the financial a comfort level that the financial information that they're looking at is reasonably accurate. We're not saying it's 100% right. Guidelines doesn't require that we do that, but we've applied certain procedures to give the insurance companies some comfort that these numbers are right. And we find a lot of times some of the bonding companies, they can be satisfied with just a review. And even some of the bankers. The last level is a compilation. This is when you don't have any financial records and we need to create them. So we'll do all of the bookkeeping and the accounting for you so that you know what your financial picture looks like. And it's amazing, so many small businesses, they don't do even a compilation. They just go the whole part of the year, and then at tax time or 3 years after the taxes haven't been filed, here's a box of stuff, I need the financials. You cannot be successful at running your business that way. You're driving blind, no map, no eyeglasses, no vision. You're just getting up doing the stuff that you do. You can't effectively manage your business without financial statements, financial records that are good, true, accurate. Okay, I've had.
How much for a compilation?
No, compilation it depends on the volume of activity and the size of the business. And the fees for that vary. It could be as low for a brand new startup who's just getting started as $100 a month to, we have some clients we charge $3,000 a month. It just depends on the amount of service, the volume of activity, the number of transactions, and if you have to have it every month, it may make sense to do them quarterly, just depending on how current your financials need to be. And it's important, if you have an accountant who's providing that service to you, don't let them just give you the numbers. You want them to help you to interpret what those numbers are saying to you so that you know, okay, maybe we need to look at this. I have a client, we're still going through some stuff because their payroll is just eating up too much of the revenue. It's like, no, something has to give. And they keep telling me all these reasons why that's happening. I'm like, okay, I'm gonna wait one more month to see if what you're saying makes sense, because it never makes sense when your payroll exceeds your revenue. You have too many people on payroll, somebody needs to go. Otherwise, your business is gonna be what goes. So use your financials to manage your business. One other thing I want to just share with you, because I think that's the end of this part of the presentation. Earlier, I had the opportunity to speak at the United States SBA. They had an event at Harris Stowe, and we were talking about the Affordable Care Act. And that's a lot of good information if you guys have employees. That stuff is coming sooner rather than later. October 1st is when the open enrollment gets started. So if you don't know anything about the Affordable Care Act, you want to start researching it, talk with your CPA. There are tax credits that are available, and you provide health care coverage for your employees. If you have fewer than 25 full-time equivalent employees, so it doesn't, you can have more than 25 people, but if some of them work part-time, there are formulas to figure out what a full-time equivalent is. But 25 or less, and your average wage is less than $50,000, then, and you pay 50% or more of the insurance premiums for your employee. You don't have to cover their family and their kids and all of that, but 50% or more of that employee's health insurance, you may be eligible for a tax credit up to about 35%. This tax credit has been in place since 2010. So if you provide health care insurance and you didn't take advantage of that tax credit, you want to consult with your CPA or your tax preparer to see if they put that on your tax return. Do we have any small businesses here who provide health care insurance? We do? Okay. Then Maria, if it's okay, I'm going to spend a little bit of time going through this because this is some really good information. October 1 starts the open enrollment, and you can go on the Small Business Administration's website and search for the Affordable Care Act, and it'll give you more information on what that open enrollment means. But there are marketplaces where you will be able to purchase health insurance for your employees. And for those small businesses who purchase their health insurance through that marketplace, that 35% tax credit starting January 2014 is worth up to 50%. And so that could potentially mean up to 50% of what you're paying for your employees' health insurance, you could be eligible for a tax credit for that. So that makes it cheaper for you to provide that to your employees. And if any of you are involved in any nonprofit organizations, if you sit on anybody's board, or if you're a trustee at your church, this small business tax credit also relates to them. And their tax credit is up to 25%. In January, it'll go up to 35% if they're providing the health care insurance. Now, in January 2014, you get the higher percent only if you purchase through the marketplaces. But from 2010 up through now, where we are right now, because the marketplace doesn't exist yet, there is the up to the 35% tax credit. Okay, we found some nice money for some nonprofits in doing that. You don't buy through the marketplace, no tax credit. You have to
No tax credit.
no tax credit. You still get a tax deduction if you pay it, but you don't get a tax credit unless you purchase the health insurance coverage through what they're calling the marketplace. Okay. You can't do that until after January. So whatever you're doing now, it's wherever you get it, it's fair game for the tax credit.
And where do you say you're going to look for this at?
Go to the US SBA, United States Small Business Administration, their website, and you can do a search on the Affordable Care Act. And even if you go to the IRS website and do a search on the Affordable Care Act, you'll get a lot of good information. A couple other things that I want to share with you on this. There is a reporting requirement, and hopefully you guys will be exempted from this, but depending on how large your organization, the amount of employer-provided health insurance premiums that you paid now has to be reported on your employees' W-2s. If you are a small business, as long as you don't issue more than 250 W-2s, you are exempt from having to report that. But if you issue 250 W-2s or more, you have to report that. And that doesn't mean you had 250 employees, because you may have seasonal employees and people who come and go, and so that's W-2s. So that's something that you need to start thinking and planning on. Especially if we have anybody in here, you do your own payroll in-house, make sure that whoever is handling that will be equipped if it eventually gets down to our level. There was a question that was asked in that session: does everyone have to participate in the marketplace? And everyone does not have to participate. You don't have to provide the health care coverage if you choose not to. For businesses with over 50 employees, you still can opt not to, but if any of your employees go out to the marketplace to get their own insurance, there will be a penalty that you have to pay. So you don't have to do it. You can opt to just pay the penalty, okay? There's a lot of good information. The other item that I thought was real important to share with you is on the Medicare withholding. The tax rate, the Medicare, you know, when you get your paycheck, you pay Social Security and Medicare, 7.65 in total is pulled out of your check, and then your employer matches the other part. Well, the Medicare part, and that was 1.45%, that went up almost 1 percentage point to 2.35%. But it's only going to affect those people earning $200,000 or more if you're a single filer, and $250,000 if you are a joint filer. Now, all the time when we're going through the presidential elections and you hear all the politicians doing their thing, they throw out the numbers like, oh, it's only for the rich people. Well, rich is a relative term, because especially if you have a 2-income earning family, it's real easy to start hitting up to those, especially a small business, especially if you get those few really nice contracts that's going to add up. We got income we need to get rid of, so we're going to pay ourselves some bonuses. Okay, so it might be easier to hit those thresholds than you think, unless we're at a very, very young starting age in the business. So I just want you to be aware of that. The other thing that has come into play, the IRS doesn't care what the city of St. Louis is doing. The IRS has federal rules and laws that it has to uphold. So there are no exceptions to the rule so far that says that because you're paying a living wage or a higher amount in lieu of health insurance, if you're not providing it, and if you 50 or more employees, then if they go out to the marketplace, you will pay a penalty.
But under 50.
So I'm exempt because.
Are you under 50?
Under 50.
If you're under 50, you're going to be okay. That penalty only comes into play for the over 50. The other item that I thought was kind of intriguing on the Medicare assessment. There's a new Medicare assessment, which basically is an increase in taxes on investment income. And it's a 3.8% tax on interest, dividends. We just talked about the dividends. So if you're a corporation and those owner draws, which you now know are dividends, there's an additional tax. A new tax is going to come into play on that. Royalties, rents, your capital gains. Now, it's only going to impact you if your modified adjusted gross income, again, hits that 200,000 level, or if you're a joint filer, 250.
Is that 200,000 after deductions?
No, that's your modified adjusted gross income. So we haven't taken into account any deductions yet. We're still on that front page of that 1040 where you're reporting all those income. So they don't give you the benefit of any of the deductions. And I'm telling you guys, it's real easy to start hitting up to those numbers. So I don't know if we have any business owners here who are business owners plus still working a regular W-2 job, but a lot of small businesses start that way. And you get a good year in that business, you're going to hit those numbers pretty soon. So those are some of the main things I wanted you to be aware of and start looking at. I'm sure you'll start getting all kinds of literature. You're probably even going to get some from the IRS that states that you have to make a determination if you're opting in or opting out. I don't know if it's going to come from the IRS, from the federal government, from the state government, but they're tracking, what the employers are doing. But a lot of it, don't let it scare you, because if you're lower than 50 employees, then you are exempted out of quite a bit of it. And there are some special rules if you are self-employed. Let's say it's only you, to where it should make it more affordable for you to go out and get insurance. Okay, so that really is a factor to where this insurance should become more affordable, because there are caps on the amounts of premiums. For ladies, they no longer will be able to charge a higher premium because you're a woman and you have the ability to have kids. So, I mean, that's huge, because that's always been a big difference. And even if you provided, and let's say you didn't have a tax bill, you effectively managed your taxes, and at the end of the year you didn't owe much, you still want to take advantage of that because that tax credit can carry backwards to previous years, or you can carry it forward. Okay, now for the small businesses, you can't get a payout for the credit, but it can be used to lower your tax bill. If you're involved in a nonprofit organization, it is a refundable tax credit where that nonprofit or your church could actually get a check back from the IRS. And I don't have, I was the tax and accounting representative on the panel. They had the other experts on how the program actually works. There are minimum insurance coverages that you would have to have. And if you purchase it through the marketplace, it's going to ensure you have those minimum coverages. Now, I'm sure that you can upgrade and buy other stuff, but there are supposed to be some real good price checking put in place to help make it more affordable. October 1st is when it opens the open enrollment. When you talk to your insurance broker, make sure you really challenge them to force you to give you information on how this is going to impact. Tell them, well, I know open enrollment starts October 1, because they're first going to tell you, oh, well, this isn't going to impact you. They're going to give you some blow-off answer because they have a commission. Right. You're taking money out of their pocket. Push back on them. Let them know, I know a little bit about this. Yeah. Yeah, to make sure that they give you some honest information, because when the marketplace opens, basically, they have other people. I won't say that they're selling insurance because they're not insurance brokers, but they have to show you the different plans that are available, and then you pick which one is going to be most advantageous for your small business and your employees.
It's excellent, but that one thing will help you stay out of tax problem.
You are a very wise man, and Marie, I think he should be the next speaker. Because what you're saying, how long have you been in business?
I've been in business 28 years.
Okay, I knew you'd been in business for some time because you've learned some lessons, some
Yeah.
very valuable
lessons.
Yeah, and I'm sure they were very expensive. You cannot get behind on those taxes. It's almost impossible to catch up once you're behind. And especially when we're talking about 941 payroll taxes.
That's the one that send you to jail.
That will send you to jail in a minute. That will have you going to the bank and the IRS then already took their money.
Because the government, what the government says, you done stole
Yeah.
from your employees.
Right, because it wasn't your
Because you
money to
took
begin
it.
with.
Yeah.
Yeah.
You took it and you spent it.
Excellent point. And that's all geared towards managing your business. Your tax bill is part of what needs to be managed. And we want to lower it every place that we can. You're probably not going to totally eliminate it. It's just a fact of life. You're in America, we're going to have to pay some taxes, but you have to effectively plan. And if it's best for you to open a separate bank account for it, by all means, do that. Put it out of sight, out of mind. So then when your CPA says you owe $30,000, you're like, okay,
You're right.
write the check.
It's
Here it
better,
is.
you don't want to
And
write
keep
it, but
going.
it's a better feeling.
Yeah, to know that you have it.
Yeah.
I always call a tax bill a high-class problem. If you got a big old tax bill, that means you made a whole bunch of money. So don't be mad. We don't like it, but you had access to some money. Now, were you smart and managed it properly? Or did you just go splurge and spend and now you got a tax bill and now you want to call me or Jeffrey, well, I've been hearing the Ronnie Deutsch commercial, can I get pennies on the dollar? No. That's why she out of business now, because it wasn't legitimate. Are there any other questions? And I hope I shared some information that was helpful and valuable to you.
Thank you.
I guess I'm done. Thank you.
That was excellent.